Most traders are marking break of structure completely wrong, and that single mistake is the reason they keep losing trades. In this video, I'm going to show you exactly how to mark BOS correctly using the general known format and ICT concepts, so you can stop getting trapped and start reading market structure like institutions. By the end of this video, you'll understand advanced market structure mapping techniques that most traders never learn, and you'll never look at BOS the same way again. Let's begin by understanding the general behavior of market structure. At its core, price movement is driven by two fundamental forces that constantly influence direction. The first force is trending behavior, which includes both uptrends and downtrends. The second force is consolidation, which appears as ranging or choppy price action. You can imagine this process as a continuous cycle where price constantly rotates between trending phases and consolidation phases that allow liquidity accumulation and institutional order placement. Typically, price must consolidate between uptrends and downtrends, and the same applies in reverse. The very first question you should ask when opening any chart is whether the market is currently in an uptrend, a downtrend, or a consolidation phase. To build a solid foundation, let's start with a simple introduction to market structure before gradually transitioning into more advanced concepts. Now, consider a market structure that represents an ideal uptrend. I describe this as ideal because it is rare to find a market that follows this structure with such perfection. Price rarely behaves in a perfectly clean manner. However, for clarity, we will first examine this ideal structure to better understand the mechanics behind an uptrend before analyzing the more realistic formations that commonly occur. In an uptrend, price consistently forms higher highs and higher lows. Price typically breaks above previous highs while protecting prior lows. An uptrend officially ends when price breaks one of the major lows to the downside. For example, in order for the bullish trend to remain intact, price must not violate this major low. Each time price breaks a significant high to the upside, it produces a break of structure, or BOS, and forms a demand zone associated with that impulsive wave. Correctly identifying valid major highs and lows is essential because it allows us to recognize potential trend continuations or reversals. Without accurately locating these critical levels, traders become vulnerable to traps and often find themselves trading against the dominant market direction. The same principles apply in bearish conditions. In a downtrend, price consistently prints lower lows and lower highs. Here, price tends to break previous lows while maintaining lower highs. Now, let's move into a more realistic representation of market structure. This structure reflects how price commonly behaves in live market conditions. Now, imagine price breaks above a previous high. At this point, an important question arises. How do we properly identify valid major highs and lows? To answer this, we begin by examining the price action to the left. We notice that price initially moved upward until it entered a retracement phase. The highest point reached before that retracement begins is defined as the major high. Meanwhile, the lowest point of the bullish leg that initiated the upward move leading to the break of structure is identified as the major low. These 2 points form our major external structures. Every price movement occurring between these 2 points is classified as internal structure. When price breaks above the major high and forms a break of structure, it confirms trend continuation. However, if price falls below the major low, this suggests a potential trend reversal. The internal fluctuations between these two external structures are irrelevant as long as price holds above the most recent major low. As long as that condition remains intact, the market remains bullish. Now that we have defined our most recent major external structures, they establish our current area of interest and trading range. As we observe, price enters a retracement phase, forming a series of internal bearish structures. Afterward, once bullish alignment reappears, price breaks the major high, generating a new major high and a new major low. This newly created major low is located at the internal extreme. This low becomes major because it is the final low formed before the bullish impulse that led to the break of structure. You might wonder why this earlier low is not considered the major low. The reason is simple. The lowest point at the extreme is the true origin of the bullish drive. This low is responsible for initiating the upward expansion and triggering the structural shift. Now, let's flip this logic into a bearish environment. In a bearish scenario, the same principles apply. just in reverse. Here, the bearish wave produces a break of structure to the downside. The lowest price point after the BOS becomes our major low. Together, the major high and major low define the external trading boundaries. Everything formed between them is categorized as internal price action. If price continues to break below the major low, the bearish trend remains intact. If price instead rises above the major high, we interpret this as a potential trend reversal. Simply put, internal fluctuations are insignificant as long as price remains below the most recent major high. As price retraces upward, it forms internal highs and lows within our defined trading range. Eventually, price resumes its downward movement and breaks below the major low. This internal high at the extreme becomes the new major high. This is because it marks the final internal peak before the strong bearish impulse. Following this move, price retraces again, forming a new major low. Then, after producing several internal structures, price continues its bearish momentum, establishing consistent lower lows and lower highs. Now let's focus on one of the most critical elements of market structure, the break of structure, or BOS. You have likely seen BOS mentioned across many trading tutorials and strategy guides. In its simplest form, a bullish BOS is often defined as price breaking a high. However, there are specific rules that must be followed for a BOS to be considered valid. Let's examine those key conditions. A valid bullish break of structure occurs when price breaks and closes above the most recent higher high using the body of a candle. Even if price immediately retraces afterward, the break remains valid. Once this happens, price forms a new major high and major low, establishing a new trading range. If price then breaks below the newly formed major low, it indicates a possible trend reversal and represents a valid change of character. Now consider a scenario where price breaks the high with a wick, but the candle body closes below the range, and the next candle fails to exceed the wick. In this case, we do not classify it as a valid BOS. Instead, we treat this movement as internal price action. To confirm a true trend shift, price must break the extreme major low, not merely an internal swing. Now consider another scenario. If price breaks the high with a wick, but the next candle exceeds that wick and closes above, we can classify this as a valid bullish BOS. This creates a new major high and major low, defining a new range. As long as price remains above this new major low, the bullish bias remains intact. Only when price breaks below this level can we consider a valid reversal. Now let's briefly analyze the bearish counterpart. For a valid bearish break of structure, price must break and close below the most recent lower low with the candle body. If price then breaks above the newly formed major high, it signals a potential bullish reversal. However, if price breaks below with only a wick and the candle closes above, while the next candle does not extend lower, we disregard this as a valid BOS. A true bearish break requires a candle body close below the low. If the next candle extends further and closes below, the BOS is confirmed. At this point, we update our major high and major low. As long as price remains below the major high, bearish conditions persist. Only a break above that high confirms reversal. Now that we understand break of structure clearly, let's move into another essential concept, the change of character. To identify a valid change of character, the first step is to determine the current market direction. Next, you must mark all valid breaks of structure on your chart. In a bullish market, price forms a sequence of bullish BOS events. The major high and low created by the first BOS define our external range. Everything in between becomes internal structure. Change of character patterns appear in two forms, minor and major. Every time price breaks an internal low, a minor change of character occurs. However, a minor change of character alone does not indicate a trend reversal. This is where many inexperienced traders make costly mistakes. They interpret a minor change of character as a full market reversal. They enter short positions prematurely. They place stops above internal highs, and price quickly resumes bullish movement, stopping them out. This cycle repeats again and again. What they fail to recognize is that price never broke the major low. Without breaking that level, the trend remains intact. The market was simply retracing before continuation. A valid market shift only occurs when price breaks and closes below the major low that initiated the bullish impulse. Furthermore, A wick penetration alone is not enough. The candle body must close below that level. The same principles apply in bearish conditions. For a valid bullish reversal, price must break and close above the most recent major high using the candle body. Wick penetration alone does not confirm a trend shift. So for the advanced ICT powerful mapping techniques, to confirm each change of character or BOS, you will need to do this. If price breaks and does not close above the most recent major high using the candle body, but has a wick above the recent major high, what you should be doing is to make sure you check the lows for SMT confirmation to know if the market will continue in the same direction. For example, the euro-dollar made a lower low while the pound-dollar refused to make a lower low, and we have prices not closing above the recent major high. Also, if Nasdaq made a lower low, the S&P 500 made a lower low, while Dow refused to make a lower low, and we have prices not closing above the recent major high. This means a market structure shift, change of character, and BOS is confirmed. And you can look for the PDA price will go to and plan for your trade setup. So that is all for now, traders. Thank you for watching. I truly hope this breakdown helped deepen your understanding of market structure. Make sure to subscribe and turn on notifications so you never miss our latest educational content. Drop your questions and feedback in the comments below, and let us know what topics you'd like us to cover next. We appreciate your support, and we look forward to seeing you in the next episode.